everyone and welcome. Here at greyhairworks, we're helping big companies solve common problems and relieve their headaches with our growing portfolio of proven and carefully curated technology partners. We find the gems in the rough. They're often fast-growing tech companies whose needs change as they scale up. Helping address those needs are our super smart pals at Haysmacintyre. They're all over new developments in the world of tax and accounting. And in this session, take us through what you need to know on what's new in the Enterprise Investment Scheme, or EIS scheme as it's known. Enjoy.
So just as a very brief introduction, the Enterprise Investment Scheme, I'm sure many of you are aware, offers very significant and generous tax reliefs. So in the form of income tax relief and capital gains tax reliefs, to encourage individuals to invest money in qualifying shares issued by qualifying companies. So the scheme is primarily designed for small, young companies that need investment to grow, but perhaps they have limited access to market finance, often because they're perceived as high risk. So our agenda today is going to be as follows. So first of all, I'm going to provide an overview of the generous suite of tax reliefs. And in order for these to be available, there are a stringent set of qualifying conditions that must be met by the company, the investor, and also the investor must hold qualifying shares. I will then follow with some things to watch out for, and then finally I'll just touch briefly on the process if you're actually thinking of either raising EIS investment as a company or thinking of making an EIS investment as an investor. So trying to coordinate here the PowerPoint. So starting off with the tax reliefs. So first of all, one of the most popular tax reliefs of the EIS investment scheme is income tax relief, which is at the time of investment provides 30% tax relief at the point of initial subscription. So if, for example, I'm investing, say, £100,000 into an EIS qualifying company, then I will receive £30,000 worth of income tax relief, which I can offset against my income tax liability. Subsequent to that, where income tax relief has been claimed and the income tax relief has not been withdrawn, then any subsequent gain on the disposal of those EIS shares will be exempt from capital gains tax. And should the shares be disposed of at a loss, this may be treated as an income tax loss. So we're used to seeing where an individual may dispose of shares that they will then give rise to a capital loss. That does apply here, but with EIS, you can also opt to actually treat that loss as an income tax loss as well. And in the event that there was a gain that was realised 3 years prior or 1 year following the point at which you're making that EIS investment, then that gain may be deferred into the qualifying EIS shares, and that gain will only come back into charge when the EIS shares are disposed of. So for all of these to apply without relief being withdrawn, essentially the EIS shares must be held for at least 3 years, and there must be no disqualifying events during that period. So I'll come on to that in a bit more detail further on. So the issuing company must remain within the EIS requirements and meet all of the EIS conditions during that 3-year period following the share issue.
Michelle, can I just interrupt you briefly? Should we be seeing your slides update?
I was going to say,
yes.
we're not seeing we've not come past your holding slide yet at the front.
Oh, I'm moving them on my screen. Oh dear. Oh, I'm very sorry about that. I have shared my screen, haven't I?
Yeah.
So you can see my title page.
You have, yeah.
But then when I'm pressing my arrow, I'm moving on.
You want to stop sharing and then try sharing again on the slide that you're on, see if that helps.
Okay. Oh, I do apologise.
That's
did
okay.
work before. Okay, I'm going to stop share. So you're going to see me. And let me try this again. Okay, so share screen, EIS, share. So now you can see it as a slideshow, but I'm going to press it as a slideshow from the beginning.
Oh yeah, that's so we can see them down the left now.
Great.
There you go. Yep.
Yeah.
But hold on, if I move,
Yeah,
can you still?
Yeah, that's
now.
working.
Got,
Okay, hold on 1 second. Let me just. So I've spoken obviously about our agenda, and then. Okay, so everyone can see that.
yeah, I think you've just done that slide, and we're going to move on to qualifying company. Yeah.
Yeah, absolutely. Okay, so, oops. Okay, so as I previously mentioned, obviously to attract those tax reliefs, there are numerous conditions that must be met, and they are quite prescriptive and govern whether a company qualifies, whether an individual qualifies, and also whether the shares acquired by the individual qualify. So the devil is in the detail. So what is a qualifying company? So these are just a summary of the main rules. So EIS companies are supposed to be inherently riskier companies. So they're unquoted companies for a start, and there are companies that are relatively small. So the number of employees is less than 250. Gross assets need to be under 15 million before the EIS investment and less than 16 million after the EIS investment. They've got to be companies that are not controlled by another company. So where you've got a group, for example, then you would need to invest in the parent entity, the top entity of that group. And if there are subsidiaries, these need to be qualifying subsidiaries. And a subsidiary is broadly any company that a company controls, and to be qualifying, no other person can have the power to control those subsidiaries. So you've got to be very careful with 50-50 JVs, and I will touch upon that later in the things to watch out for. Where the companies are UK incorporated, then the test for having a presence in the UK is of course met. However, the companies themselves do not need to be UK incorporated companies, but where you've got a group, for example, and it's the parent company issuing the shares, then it needs to have at least a permanent establishment in the UK, which is defined as a fixed place of business. And you could, for example, have an offshore company that has a branch in the UK, and that would still be okay. So as well as the company size limits and rules, the company also needs to undertake a qualifying trade. And a qualifying trade is broadly anything that is not defined as an excluded activity. So excluded activities are listed in the legislation, and predominantly they are property-backed or finance-backed businesses that are excluded. So for example, property investment, hotels, farming, dealing in any kind of obviously land financing activities such as lenders and financial services like accountancy and legal services are excluded. You can, however, carry on some excluded activities as long as they are not considered substantial. And this is generally defined as being 20% of total activities. And this will look at certain factors, for example, turnover, gross assets, management time. The risk to capital condition is predominantly there to stop a lot of EIS type products that were in the market. So you could go to an IFA and say, I want to invest in an EIS company. and they say, oh, I've got all these businesses you can invest in, and they're not particularly risky, so don't worry, you won't lose your money and you'll get all your EIS relief. So to stop those type of businesses being able to qualify for EIS, this risk to capital condition was brought in, and it now really emphasises that the companies that can qualify are those with objectives to grow and develop the trade in the long term, and there has to be a significant risk that the investor will lose their money when they invest in the company. So there are a number of factors to consider when you look at that. The funds raised by the company must be spent within 2 years on the qualifying business activity. And the companies also have limits on how much they can raise under EIS. So companies have a lifetime limit of 12 million and an annual limit of 5 million. So as well as the qualifying company having a set of conditions, there are also a number of conditions that must be met by the investor. So broadly, for an investor to qualify, they must be subscribing for new shares in the company. So they cannot buy these shares off anyone else when they enter in, or they can't have them transferred to them by someone else. So they have to be new shares issued by the company. And they cannot have any connection to the company. And connection means that they can't be an employee and that they can't hold more than 30% of the share capital for the company. So for EIS, you can become a director post-investment, so long as you meet certain conditions post-investment and there is a business angel investment exemption. But you have to therefore be really careful with EIS, with the order of events in terms of when the individuals become directors, and all of these rules tend to be governed by the date the shares are actually issued. An investor has to be an independent investor, so this means that they can't hold any other shares that haven't been subscribed for under some other risk finance investment in schemes such as SEIS or VCT or EIS itself, unless, for example, those shares are subscriber shares on incorporation of the company. And individuals also have limits on how much they can invest in the EIS company. So an individual can subscribe for up to 1 million per year, and this can be spread across as many companies as one wishes. So finally, we've got the qualifying shares. So that the shares that the company is looking to issue as part of the fundraise need to be qualifying shares. So they need to be ordinary shares. They need to be paid up in full at the date of issue. So there can't be any amount outstanding when you issue the shares, and that point is really important. There can be no preferential rights over those shares. So if you've got multiple classes of shares, the EIS shares cannot hold preferential rights over dividends or assets on winding up over any other class of share. So this takes us back to the EIS being riskier investments. So these rules broadly preclude you from having additional protection or additional preference, which in theory, of course, will de-risk your investment. So particular care is needed where, for example, you've got growth shares. It's not impossible, but it does need careful attention to the wording in the articles, such that the EIS shares rank after the growth shares. There are a number of other requirements that have come in the last 5 years or so to further restrict the EIS. And the first one is that, when we write to HMRC with our clients who are making an investment under EIS, we have to really make it clear that the purpose of the funds that are being raised are to promote the growth and development of the business. So the business is looking to be a long-term business, and the funds are there to perhaps take on or new employees or invest in new technology, and it's not, the funds aren't there to, for example, repay debt, and especially not shareholder debt. The funds also can't be used to acquire other companies or businesses either, by the way. So the qualifying trade also now has a maximum age limit. So the trade can't be older than 7 years when you go to raise EIS funds. So from the share issue date, the company must have started trading within the 7 years prior to that, and the trade can't be older than 7 years when you go to raise EIS funds from the share issue date. So there are some exceptions to that, and the first exception to that is that actually the trade started more than 7 years ago, but the investment round that you're doing now is one of a number of EIS investment rounds you've done in the past, and the first EIS raised is for the same qualifying business activity that was in the first 7 years. And the secondly is broadly where you're looking to pivot the company. So the company's older than 7 years, but what you're doing is looking to enter into a new market or a new geographical area, and the amount that you're raising is significant. So it's more than 50% of the last 3 years average turnover. So the rules are very prescriptive. So if you are looking at some of these exceptions, then they do need to be looked at in detail. So things to watch out for. So we touched upon that the shares must be paid up in full and in cash on the date of issue. So if HMRC do ask the question, they do ask for bank statements, etc., as evidence, and the EIS shares cannot have any preferential rights. So yeah, there are no arrangements to protect investors, so you've got to be careful that there are no clauses in the articles that would counter that. With regards to the joint venture companies, a company must have qualifying subsidiaries, and this is defined as subsidiaries in which 51% or more is held of the share capital and there is control. And therefore that's why you have to be careful with joint ventures, whereby you could have a 50-50 shareholding structure. So you don't have 51% of the share capital, but somehow you have control, and that might be either via the articles or the shareholders agreement. So if that is the case, then it wouldn't be considered to be a qualifying subsidiary. Share buybacks, so this can restrict a company's ability to raise EIS relief and clawback of EIS previously raised if funds are used for the buyback. So you have to be very careful here. And for share exchanges, if you want to put a new holding company on top of an EIS company, then again, you've got to be very careful that you can do that. And the EIS should just flow through with the new parent entity, but it does need to meet stringent conditions. And finally, it's just to be really wary that where business has been trading for more than 7 years, has it been trading, for example, in a different guise or a slightly different ownership structure by the same people, then you need to also be careful that that condition is met, and that actually you may think, oh, the company's only is 7 years or younger, but actually it is potentially older than 7 years. And where an EIS company like ceases, shall we say, to meet any of the EIS qualifying conditions in the 3-year period in which the EIS shares are being held, or the investor or the qualifying shares, or there is an event such as a share buyback or something which isn't done, correctly, for example, then there is a risk that if it gives rise to a disqualifying event, then the EIS investors income tax relief will be withdrawn, and with that they will also lose the capital gains tax exemption on their shares. So yeah, you have to be very careful with EIS. And then finally, just to give a brief touch upon the process. So I'm sure most of you are aware that HMRC has an advance assurance process which it can use before it raises funds under EIS, and this enables the company to get a document from HMRC which it can then provide to its investors to provide comfort that it is a qualifying company for EIS. So you can only do this when you're close to the investment round. So when you actually have the names of the investors and how much you're planning to raise. And HMRC do require a lot of information with this advance assurance process. So for example, business plans and forecasts of how the funds are going to be used once raised, and articles and share rights, etc. And then once the investment has been made under EIS, there's a further application that goes into HMRC, which is referred to as an EIS 1 form. And this essentially is a declaration to HMRC that all of the EIS qualifying conditions have been met by the company. So this EIS 1 form is submitted by the company. And then once the EIS form is submitted by the company, HMRC will then in turn, once that's been logged, issue EIS certificates, which will then be provided to the investors, and the investors will be able to fill those in, and then they also must then make the claim on their tax return in order to claim for EIS. And one point that I would just like to make is that where an investor doesn't have an income tax liability, they may not think, oh, I need to make the claim on my tax return because I'm not going to be claiming income tax relief. But if they fail to make the claim for EIS income tax relief, even though they haven't got an income tax liability, then they are at risk of actually losing the capital gains tax exemption when they actually come to sell their shares or dispose of them after 3 years' time. So that is all for now.
That was
I hope
great.
that was helpful.
That's
I'm
like a
sorry.
whistle-stop
I'm
tour.
really sorry for the hiccup with the slides.
Oh, that's okay. I think,
No,
yeah, it's fine, Michelle.
no
That was
problem.
good.
No.
It's a huge subject, and that was a great whistle-stop tour. So we've got a few minutes left. Are there any questions from the floor? Daniel.
I have one that might be a slightly strange scenario, but assume we've got an EIS or an SEIS qualifying company who has raised money under an SEIS scheme, and they effectively exit in a pure equity transition with another company. So a share swap effectively, I guess, or an issuance of shares in the, call it the acquiring company. Does EIS cease at that point and all the benefits go away, or is there some way of identifying a potential gain from that transaction? Let's assume that the acquiring company is not EIS qualified, nor are they public, so there's no.
And in terms of, you were saying the share for share swap, the end result though is going to be that the EIS qualifying company is going to be under
let's say
control.
Let's
it's going to be
yeah.
the control is going to be different of it.
Yeah.
Yeah, I think personally, I mean, I think that would be a disqualifying event for an EIS investor. But as I said, there are definitely like, for example, that I did mention, like for the share for share exchanges, you have to be particularly careful, but this sounds like it is an actual exit, and you're exchanging your EIS qualifying shares for shares that would no longer be EIS qualifying.
That's one potential outcome, yes, and I guess it's a decision about the nature of that transaction that maybe the alternative is for the company to itself hold shares in the acquiring company and keep keep on going on that basis until there's some kind of exit for the acquiring company. Who knows?
Yeah.
So
okay, Jeremy, can we follow that one up afterwards?
Yeah,
Daniel's
sure.
got a question and we're running out of time. I'll connect you all up afterwards, as mentioned. Daniel, off you go, mate.
I had a couple, but just the one as we're running out of time. What's the process now to qualify to be an EIS investor? Is that just simply a sort of self-certification exercise these days?
Yeah, so you have to make sure you get your EIS certificate after the company submitted the EIS1 form. You have to make sure you get the EIS certificate, and then you have to submit that and actually make the claim on your self-assessment tax return. So the year in which you actually made your EIS investment, as I said before, even if you haven't actually haven't even got an income tax liability, it is crucial that you still make that claim on your self-assessment tax return that you have made an EIS investment in that tax year.
Sure. I mean, I suppose where my question is coming from is I've had a couple of invites to invest, and as part of that, there's questions around, you know, proving that you've got the funds, proving that you sort of know what you're doing, that type of stuff. Yeah. And do you need to provide any sort of evidence around that, or not?
Are you talking about, sorry, to the EIS company?
Yeah.
That might be to do with them asking for evidence that you're a sophisticated investor of sorts, and a high net worth, and therefore I imagine they're doing that to keep out of any potential FCA regulatory complications by relying on the fact that you're self-certifying that you're a high net worth and therefore a sophisticated and a sophisticated investor.
Well, that was really useful and insightful. Thank you to Michelle and Tash at Haysmacintyre, and thanks to you all for joining us, and we'll see you next time.